All right, hello everybody. I'm doing a quick video to basically answer the question that was brought up in regards to the housing market and comparing it basically to 2008. So I'm going to put it in play mode here. And look, I hear it all the time, the market's too expensive, which, it does seem like it's a bubble, right? And a lot of people think that the market is going to crash. And I get it. If you lived through 2008, right, it kind of left a scar on all of us. It was traumatic, right? I actually got my real estate license back in 2006. And people, just they lost everything. They lost their homes, they lost their retirement savings, all confidence in the market, and fear makes sense, right? And others, they just have no idea what it was like because they're just too young and didn't live through it. So it's hard for them to know what's going on, right? And understand this market that we're in. Now, I'm not saying I have a crystal ball and I know what's going to happen. I think AI will disrupt a lot of things. And, we don't know what the path ahead is. But if you lived through 2008 and you saw what happened, you also know that this is a very different time. And when you actually look at the data, not the headlines, right? Not the fear, not the YouTube gurus out there trying to get you to, click on their videos, a lot of clickbait, a lot of misinformation. When you look at the actual numbers, today's market is nothing like 2008. And I mean, absolutely nothing like it. So I'm going to walk you through this. I put together a full slide deck on it with a lot of stats and comparisons side by side. And by the end of this, you're going to be, basically thinking a little bit differently if you were thinking that we are headed to like a 2008 crisis, right? So here's what we're going to cover. Let me just, okay, here's what we're going to cover. The macroeconomy, right? We're going to look at like 6 different things. The macroeconomy, delinquencies and foreclosures, right? And I'm going to be comparing them. Homeowners equity, lending standards, what they were back then and what they are now, very, very different. Mortgage-free homeowners, housing supply, and some key takeaways. Okay, so we can kind of wrap this all up into a bow. So number one is the macro economy, right? The GDP. This is the big picture stuff, right? So during the financial crisis, GDP contracted a negative 8.9%. Okay, it went down 8.9%. If you see right here, right, Q4 of 2008, it went down. Right now, well, in Q3 of 2024, it went up 4.4%. We don't have all the data coming into 2026 yet, but it's coming out and it's not going to be like that. The labor market is healthy, right? GDP grew 2.8% in 2024. The Fed has been cutting rates and it's been like measured and controlled, right? Not like this huge panic. They brought rates down from about 3.5. That's not an emergency. That's just like normal monetary policy, right? So 5.5 to 3.5 or 3.75 is not horrible. It's not like it went down to the 0% that it did back in the great financial crisis. The 30-year mortgages, this is very similar, right? 6.3, it went down to 5, and then 6.7 to 6.2. So that's not that different. Consumer confidence was super low. And over here in January, we do have data, it's super high. So the economy was in free fall during the great financial crisis. And today we have sustained growth, we have low unemployment, and we do have a functioning labor market. So the macro backdrop is just super different, right? I mean, look at the differences here. Okay. So number two, and this is kind of what, some people have been talking about. Specifically, Fadi mentioned delinquencies and foreclosures are on the rise, which, is true, but let's compare it, right? Let's compare it to the great financial crisis. So this is what kind of broke in the market in 2008, which was defaults. People couldn't pay their mortgages, and that's why we had a surge in inventory. So at the peak of the crisis, guys, 10% of all mortgages were delinquent. 10% were delinquent. Okay. 1 in 10 homes. So that's serious delinquency, meaning 90 days or more past due, was at 9.67%. And foreclosure filings hit 2.9 million in a single year. So banks were repossessing over 1 million homes per year. So today, the total delinquency, right, that's total, is 4.26. So that's 58% lower. And serious delinquency is only at 1.85%. That's an 81% difference. And I get it, right? It's where we are right now versus the great financial crisis peak, right? But it is, it is a huge number off. And the big one here is the foreclosure starts, right? In the great financial crisis peak, it was 1.4%. Okay. Now it's 0.2%. So down 86%. Annual foreclosure filings, 2.9 million versus 322,000 in Q4 of 2025. And bank REO possessions, I mean, you can't even, compare this, right? So bank repossessions have declined 97% from crisis levels. Foreclosure filings are down 89%. And the one area to watch, which is FHA, that's really the one that, is putting pressure on the foreclosure stats. It's at 11.52%. It rose 11.52% in Q4 of 2025. So that's a sign of stress among lower income borrowers. Okay, but conventional loan performance remains near historic lows at 2.62%. Okay, now let's look at this homeowner equity. Okay, this is the one that if you remember nothing else from today, remember this slide. Okay, remember that this is the single biggest difference between then and now. Look how big of a difference. During the financial crisis, the total homeowner equity in America collapsed to $5.3 trillion, right, of all equity in the United States. And 26% of all mortgage homes were underwater. 26% of all homes, right? So that's like 3 out of 7 homes almost were underwater, meaning they owed more on their house than what it was worth. That means that 1 out of every 4 homeowners owed more on their mortgage than their house was worth, and almost hitting that, 3 out of 10. In Nevada, guys, it was the worst over there. It was 61%. Think about how crazy that is. 61%, 6 out of 10 homes. So today, look at the total homeowner equity. $35.8 trillion. That's 7 times this number. 7 times. Okay. Now you might say, oh yeah, well, that's exactly what I'm talking about. We're in a bubble. Well, let's keep looking. Only 2.2% of homes are underwater, right? Equity has, and that, guys, that has a lot to do with because of the mortgage lending standards, which is next. Okay. That's very important to understand that now, if you're a realtor, you know this, right? People are putting 10, 20% down when they're buying a house, right? Of course, the FHA people are putting 3% or 3.5% to 5%, but the majority, are not putting that. In order to be competitive in this low inventory market, people had to put bigger down payments down. Therefore, the total homeowner equity is much, much higher. And there's only 2.2% of homes that are underwater right now, compared to 26% in 2008. Okay. So if you just compare the stats here, I mean, it's pretty absurd, right? Tappable equity with a 20% cushion, meaning if the market went down 20%, there was like very, very little homes that had any sort of cushion. Here we have $11.5 trillion of cushion. That's a big difference. Okay. Average leverage on mortgaged homes was 60%. Now it's 45%, right? That's a 25% difference. Very, very big. Now this, in my opinion, is like just logically the way that I look at this is what makes the big, big difference. Okay. So what caused everything in 2008, right? Because it didn't just happen, right? It was built. right? Loan by loan, they were giving all these loans out, and they were called ninja loans. No income, no job, no assets verification. And look at this stat. By 2007, 80% of correspondent loans were defective, meaning that they didn't have the proper documentation. Stated income liar loans, they called them, 3.2 million home purchases. 1/3 of 2006 mortgages were subprime or no doc. Okay, this meaning people couldn't afford these homes, but they were buying them with very, very little down payment. Okay, a lot of them, no down payment. Okay, then we had negative amortization ARMs, adjustable rate mortgages, where the loan balance grew over time to keep their monthly payment down. So then we could just keep propping up these prices, even though people couldn't afford them, right? They were just propping them up. 75% of borrowers made minimum payments only. Okay, minimum payments only. So it's like everybody did this on credit cards, basically, right? And you know, they weren't ever going to really pay that down. They were just hoping that it would appreciate it away, and it didn't, right? Then the collapse happened. 100% loan to value and zero down. 80/20 piggyback loans gave buyers zero skin in the game. So there was first lien holders that would give you 80% of the mortgage, and then there was other lenders that would give you 20% of the remaining amount, right? So obviously, you know, people were just buying these houses with zero down, and they were just trying to get in the game with no skin in the game, right? So they were careless, right? And they lied, right? And they had these no income, no job, no asset verification loans, right? That's very, now it's hard to get a mortgage, guys. I mean, go get a mortgage. Go try to get a mortgage and tell me if it's the same as 2006, 2007. You know, it's hard. They look at every detail. They ask you for every bank statement. Okay. The teaser rates on the ARMs, rates below 4% for 2 years. Okay. Then they doubled or tripled, right? So there was a lot of shock in the market. So then we had Dodd-Frank, right? It completely changed. Everything changed, guys. Okay. Because when they passed these new rules, banks actually had to verify documentation, right? Just look at where we are today. Every single one of those products that we used to have in 2007, 2008 are gone. Dodd-Frank completely killed all of them, right? And they have what's called the ability to repay rule, means that lenders have to actually verify you can pay your mortgage, right? Imagine that. Like before, they would just check your pulse and they would give you a mortgage. And subprime, okay, lending went from down all the way from 21% at a peak all the way down to 3.6%. And the median credit score at origination went from the low 600s to 746 to 758. So you have to fall within this as the median FICO at origination. Okay, compared to back then. Look at the borrowers back then and the borrowers now. Okay, over the last couple of years. Think about that. It went from a tremendous amount of difference. Okay, adjustable rate mortgage share of originations. Now it's 5 to 10. Before it was 42%. It was almost half the market. No doc loans, we don't even have that anymore. 33% of the market. Negative AM loans was 10% of all borrowers. Now it's prohibited. Okay, 100% LTV with zero down was available to everybody. Now it's only VA and USDA. Very, very small percentage of borrowers. And the market default risk, right? Look, 12.5%, now 4.8% positive. Okay, so if the current default risk was doubled across all channels, risk would still be well within the pre-crisis standard. If it doubled. So just, you know, understand that there's a huge difference. Now, let's talk about this. And I've talked about this with you guys before. Homes owned free and clear then versus now. So pre-crisis, you have to understand a lot of baby boomers owned homes and now they're all older, right? From, you know, whatever, that's 15 years ago in 2008. No, 18 years ago. What am I talking about? So all those people are older, right? They aged up, right? So before pre-crisis, 2005 to 2007, you had 29 to 30% of homes that were paid off free and clear, no mortgages. Okay. Today we're at 40%. So It's 35 million homes that are mortgage free. This is an all-time high. Okay, that they don't have a mortgage, so you can't, you know, you don't have to worry about a mortgage default. Even if the market went down, these people are not at risk. Okay, 35 million mortgage-free homes are completely immune to interest rate changes and mortgage market stress. 54% of mortgage-free households are age 65 plus. Boomers who paid off during low rate era, right? A lot of people refinanced and they were just paying it down faster. 81% of existing mortgages carry rates below 6%. So 81% of existing mortgages are below the 6% rate, right? That wasn't the case when they were adjusting up, right? With all those loans that they did over here, right? They had the ARM loans, 42% of them were adjusting up. Okay, very, very different times. Okay, average outstanding rate is just 4.3% interest. And the lock-in effect means 54% of homeowners say no rate would make them sell. Pretty crazy. So now number 6, right? Housing supply and demand. Let's see how different it is. Okay, the active inventory, 4.5 million homes in July of 2008. Okay, just think about that for a second. 4.5 million homes versus only 1.2 to 1.5. Okay, so what does that mean? In 2008, we had a massive oversupply problem, and builders were, they went crazy during the boom, right? Because they all wanted to make money. That's why builders are, now they're kind of building more, but they're still like very, very weary. Okay, 2 million housing starts in 2005, guys. Inventory hit 4.5 million homes for sale. We had over 11 months supply. We're at like, in Jersey, we're at like 1.5 to 2 months. They had 11 months of supply sitting on the market. Vacancy rates were at record highs. There were too many houses and not enough buyers. Okay, there were too many houses and not enough people that could buy a house. Why? Because Dodd-Frank happened, and then they said, okay, well, you have to have, even though houses went down in price significantly, in some areas down 60%, people still couldn't buy the homes, and people were like, they were fearful. Today, we have the opposite problem that we had back then. We're short 3.7 to 5.5 million homes, depending on, whose estimate you use. The active inventory is around 1.2 to 1.5, depending on whose estimate you use, a third of what it was in 2008. So the month's supply nationally is like 3 to 4.5. In Jersey, it's even less. Okay. So it's firmly in undersupplied territory. Under 6 months, it's a seller's market. Over 6 months, it's a buyer's market. And the homeowner vacancy rate is under 1%, which is near record lows. Okay. Over here, right, 2.8%. So that is why prices, aren't crashing, even though rates are, still at 6%, a little bit less now. There simply aren't enough homes, right? From 2008 to 2019, we underbuilt about 5.5 million homes, and that deficit is barely shrinking. So we're building 1.37 million homes a year against 1.5 million in household formation, right? Meaning that there's more buyers than there is sellers and inventory and people building homes. So the undersupply is like the floor under the home prices. So during the great financial crisis, prices dropped 27 to 33% nationally because there was just too much inventory and a lot of distressed sellers. Today, even with affordability being at historic lows, that's the issue that we have, is affordability, because wages haven't kept up with appreciation, right, and inflation. Prices are still going up because there's nowhere near enough supply. That's the issue, right? And now with rates kind of stabilizing at a lower number, that kind of changes things. So here's like the full picture, every metric that we just discussed. And look at the difference between the 2007, 2009 era and 2005, 2026. Right? The only thing worse is affordability right here, right? By a few points. Everything else, look at this, is crazy. And that's also because we've printed so much money during COVID. I think 40% of the money was printed during COVID. So we had a crazy amount of inflation. And now with AI, it's going to be probably worse, right? And I think that we are going to have some sort of issues when it comes to unemployment. And there's going to be some pain in the middle there, before the government intervenes with either a universal income or something of the sort. Okay, I think affordable housing is gonna like it's gonna blow up because anybody that has affordable housing properties is probably gonna get all sorts of grants and stuff by the government. I would just predict that, right? I would guess because the middle is getting smaller, meaning the rich are getting richer, and the poor have lived off the government, but then the middle class is shrinking, right? Because the middle class or the working class are the people that have been working in jobs, and a lot of those jobs are probably going to be disrupted by AI over the next 5 or 10 years, maybe sooner. So here are some key takeaways for us. This isn't 2008, right? Every major risk metric from delinquencies, equity, lending quality, supply, it's at a fraction of the crisis levels back then. So the structural foundation is just completely different, right? Is it possible that something else, another black swan happens? Yes, of course, right? But right now, this is where we are, and you have to go off of the data. The equity fortress is real, meaning that there's so many people that just have a ton of equity in their home from the down payments that they put, from the low rates that they have. The amount of people that are underwater is only 2.2%, and even a 10 to 15% price decline wouldn't create a systemic risk. It wouldn't, because a lot of people put bigger down payments. And guys, it's very different psychologically when you have no skin in the game on a property to walk away if the market goes down 10 or 15 or 20% versus somebody that did put 20% down and then the market goes down 15 or 20%. Okay, so keep that in mind. There's a lot of skin in the game right now. So if the market does drop, people are still going to hold on. It's kind of like buying a stock at $10, right? It goes to 13 and then it goes back down to 11. Are you selling, right? If you live in that house, like, no, you're not, right? And you're still up, right? You still have some equity. You're going through it, Now, of course, if you lose your job, you lose your income, that's a problem. 40% own their home free and clear. That's 35 million households. They're completely insulated from anything that happens, from interest rates to the market going down, all that. And supply is the main story, right? We're short a lot of homes, and the undersupply creates a price floor. It actually keeps appreciating because of that. So, the affordability, obviously, it's a real challenge, and housing is less affordable than at the 2006 peak, but this is driven by undersupply and rates, not by the toxic lending, right? So that's important to just understand. So look, guys, knowledge gives us the competitive advantage. We have to keep plugging away. There's still opportunity out there. And again, we hold properties for a few months, right? And rents, they don't typically go down. Whether you're in affordable housing areas like Pittsburgh, like I am, or you are in more affluent neighborhoods, you're going to be fine. If you're in the middle, right, and you're renting properties and you're barely breaking even, then that's probably where the risk is. But hopefully this was helpful, and I'll see you guys tomorrow on the Monday call.